Question of the day. Are high credit score borrowers really going to pay a surcharge for those with lower credit scores? Well, it's a complicated answer, so stay tuned. Essentially, what we have, and let me get a little detailed here, is the agencies, Fannie Mae and Freddie Mac. They are in a conservatorship with the FHFA, the Federal Housing Finance Authority. What does that mean is after the foreclosure crisis, there was a lot of instability with Fannie and Freddie. And so to stabilize them so that our mortgage industry didn't totally collapse, they took a conservatorship over Fannie Mae and Freddie Mac. Fannie and Freddie, the agencies, they set the guidelines for all mortgage lenders, and it creates stability in the industry. And so from product guidelines to what we call LLPAs. And this right here is the big uprising. What are LLPAs? Are loan level price adjustments. The great thing about this industry and this profession, why I love it so much, is no two loans are the same. You know, you may have several loans with a 760 credit score, but somewhere in there, the parameters are going to be different, from loan to value to loan program to purchase price. So every loan gets a little, unique, as we say, in just the way that it is. Now, with this, FHFA just announced some new loan level price adjustments, and it's causing an uproar. And I'm seeing article after article just saying about this surcharge, and it's going to penalize really good borrowers, well-qualified borrowers. Is this necessarily true? I'm going to say yes and no. Okay. So first and foremost, it's not an add to the rate. So it's not that the rate is 6.5 and this 780 credit score is borrower is going to pay 0.25% higher and they're going to pay 6.75. It's not like that. When we look at interest rates, the rate that's offered to you is more built out of your loan scenario. There's about 30 different factors that go into what is the rate that's offered to you, okay? This is what is the loan amount, what's the loan to value, what's the combined loan to value, what's your credit score, what's the program, what's the lock period, what's the amortization term. There's a lot that goes into this. And if we just have one deviation, the difference from a 720 score to a 680 score, 720 to 780, we're going to see some difference in the actual pricing, which correlates to the interest rate. And I know this is kind of a little tough to swallow, but think of it as I go through a rate sheet and manually calculate, okay, what is positive for your scenario, right? So everything in the mortgage world is all based upon risk. The higher the credit score, the larger the down payment. These are things that are going to attribute with a more confidence that we're going to be repaid the money that we lend. Part of, and why do we call it the historical foreclosure crisis, was somebody that could come in with a bare minimum 620 credit score could have purchased a home with 100% financing. And with leveraging your money, this is the risk of when times get tough, that borrower has no money invested other than their pride from walking away from that home, okay? And so when you actually have equity and you have a principal down payment, 30%, you've invested 100, 150,000, whatever that number may be, the odds of you walking away from it are going to be exponentially lower, okay? And so this is kind of how it correlates into the risk of the rates that are offered to you. Now, what this most recent LLPA announcement, which takes effect actually today, May 1st, is they've found that with the first-time buyers, that there was a lot of adds to the actual pricing. There was a lot of adjustments. And so it was some, kind of the mentality that those that need it the most were paying the most. And, we all start somewhere. And so here's the devil's advocacy is, just because you're buying your first home and you haven't built up years of equity and you're putting down 5% on your first home, should you pay a lot more than somebody that does have a larger down payment? And so what they've done is they've restructured this LLPA grid. And so the grid, goes from loan to value to credit score. And really at that starting intro phase, what they've done is they've reduced a lot of those price adjustments, again, to give a leg up for the first-time home buyers, okay? Now, when you say you've discounted at the minimum level, now you're equivalent or comparable to some of the incentives of those that are higher credit score and that have put down a larger down payment. And so when you look at the grid, it does appear that there are a few instances where some of the LLPAs are slightly higher for a higher credit score and a larger down payment. And really, looking at this grid, and I can post this for everybody to see, is it's about the 80 to 85% range that we're going to see some minor adjustments. Now, in the grand scheme of things, to me, this is irrelevant. It is always nice to help the first-time home buyer, right? We all need to get started somewhere. And if we just keep pushing that risk factor and pushing that, we're going to have no incentive for new home buyers to come into the market. And so we want to make it affordable as we can, right? It's, it's understanding that, yes, they're borrowing more money. So it's still going to be a sizable loan and a sizable monthly payment and responsibility. But if we can save them $30, $40, $50 a month on their first home, they're still paying what I feel is their portion of risk. With looking at the chart, some of those areas, whereas you can see that the pricing may be a quarter higher, not the rate, the pricing. So if both rates were the same, one may just have a quarter pricing or a quarter of a point to pay, and that's equivalent to 0.25% of the loan amount. Maybe that equates to a one-time fee of $1,200, right? It is not thousands of dollars over the life of the loan. There is some adjustment. Now, as a great lender, we should always be speaking with our clients about options, right? Because here's the thing. There may be some incentive at 5% higher loan to value. It may be beneficial for you to put a little bit less money down, or maybe more beneficial to put a little bit more money down. We can work with you to guide you so that you shouldn't be impacted and or minimally impacted at most. Here's the second part. We've seen over the last, I've been in this 23 years, rates are in the mid sixes as of now on a 30-year fixed. That is a normal and a reasonable rate. Now, you might not want to hear that coming from a 2.875 on your 30-year fixed from unprecedented times of COVID. However, it is a realistic rate. And so I'm not saying that you're spoiled. I'm just saying, as a long-term industry veteran that's been here for 23 years, let's not focus on where it was. Let's focus on where we are and where we're actually projected to going. Now, very soon, May 10th, 9 days away, we have some additional reports coming down where we really feel in the industry, this is going to be some information that's valuable for us to be on kind of the start of a downward trend in interest rates. So what you may see as negative today, in 2 weeks, if I can offer you a quarter or even 0.5% lower, none of this even plays into or makes a big deal, because as rates come down, you're not going to feel the impact of this. And even now, at worst case scenario, it is very minimal impact at most. To be honest, I've even kind of reluctantly shied away from posting a video because I don't want to focus on negative news. And this is something that I've just seen over and over, that it's negative. And as I got enough questions from my friends and DMs, it was like, let me address it. And so here we are. Yes, it is true, but again, it's going to be minimal in impact. Now, we do have some lawmakers that are lobbying for you. Right now in the House of Representatives, there's the Responsible Borrower Protection Act of 2023, and they're going after FHFA. They're trying to limit these adjustments, do away with them, and actually protect us, not just now, but also in the future, moving forward, some of these adjustments. And one of the proposals was even for a debt-to-income ratio, LLPA. And that also makes it a lot more challenging. And I believe the whole industry, besides FHFA, is against enacting something like that. So thank you for listening to me kind of clarify what it is. I hope you see this more in a positive light than negative. If it is something that really bothers you, what's great is you can reach out to your representatives to support the Responsible Borrower Protection Act of 2023. And as you know, we're always here to answer your questions, respond to you as we can. So thank you for your time.